Okay, so in the first half of this chapter, we cover the accounting for different types of stock, how to account for treasury stock, resales of treasury stock, and retirements of stock. In the second half of the chapter, we're pretty much just going to concentrate on different types of dividends and how we account for these different types of dividends. So the dividends we'll cover are on the slide. We'll also include a little bit about stock splits. Technically, it's not a dividend, but it's pretty similar to a stock dividend. So we're going to discuss those two together. Okay, so first is cash dividends. So pretty much cash dividend just means over time a company is going to generate profit, and then it's going to pay out some of its profits to its shareholders through these cash payments called dividends. So whenever we pay out dividends, we're pretty much paying it out from our retained earnings. So in other words, from our earned capital. As we saw earlier in the chapter, your earned capital is part of equity. So every time we pay a dividend, we're going to be reducing our equity. Right? And so, in fact, all dividends except for stock dividends will reduce equity. Okay, so let's see here. So dividends only paid on stock outstanding, and just for dividends, whenever dividends are stated, they can be stated on a one per share basis. So in other words, you could say dividends of $3 per share or something like that. Or it can be stated as a percentage of par. So in other words, if it says 5% dividends, then it's paying 5% of par. Okay, so with dividends, generally there's going to be 3 dates. The first is the declaration date. On the declaration date, all the company is doing is it's announcing that it's going to pay dividends. All right, so if we're announcing that we're going to pay dividends, we have now created an obligation for ourselves. So we'll credit dividends payable, and your debit will be to dividends. Okay. So the second date after that of importance is a record date. All that's happening on the record date is the company's determining who its stockholders are, so it knows who to pay those dividends to. Right, so if you think about what's happening on this date, no assets, liability, or equity is changing. We're just figuring out who our stockholders are, so there is no entry on this date. And then the very third date is a payment date. So as the name suggests, you're now paying dividends. Okay, so since we previously announced the dividend and accrued a liability, and we're now paying it, we're now satisfying the obligation. So make a debit to dividends payable. And since it's a cash dividend, we're paying cash out to our stockholders. We're going to credit cash for the amount of the dividend. So these are your 3 important dates here. Again, record date, there's no entry. Declaration date, payment date. Hopefully this should be review from principles or accounting 301A. Actually, you don't cover dividends there. But yeah, this should still be review. So just as an example, on March 14th, the Board of Directors of Echo Bay Limited declares a cash dividend of 40 cents per share to shareholders of record April 1st, 2001. Dividend is payable on April 15th, 2001. On April 1st, Echo Bay has 700,000 shares outstanding plus 20,000 shares held as treasury stock. So the first date is the declaration date, as we mentioned, of March 14th. Next, I'll make the journal entry here. So we are declaring a cash dividend of 40 cents per share. And on April 1st, which is our record date, we have 700,000 shares outstanding, right? And then we have 20,000 treasury shares as treasury stock, but those 20,000 shares, since it's treasury stock, the company owns those. Pretty much, they're not going to pay a dividend to themselves. So this is only, our dividends are only paid on shares outstanding or shares held by stockholders. Okay, so we have 700,000 shares. The dividend is 40 cents per share. So that should get us to 280. So we'll debit dividends for 280 on this date, and we've declared we'll pay them, so we have a dividends payable for 280. All right, record date, as I mentioned, we're just figuring out who our stockholders are as of April 1st, so there is no entry for this. And then payment dates, well, now we're paying off these dividends that we previously declared. So we can remove the dividends payable from our books. This will satisfy our obligation, and we'll credit cash for the 280. Okay, so hopefully that's relatively straightforward. Okay, so second type of dividend we will cover is a property dividend. So a property dividend just means we're going to pay out some type of asset, generally other than cash. So while technically we could pay any type of asset as a dividend to our shareholders, so it could be like real estate, merchandise, or something like that. Generally, the other asset, this asset other than cash, is always the stock of some type of corporation. Right? Because if we think about stock, we can easily split it up and allocate it among the stockholders. Whereas if we have a building, well, how do I really divide a building between people? So to account for a property dividend, then it's pretty much the same concept as cash dividend, except now instead of crediting cash when we distribute our assets, we're going to be crediting whatever asset we're distributing. So if we're giving stock of another company, we're going to end up crediting an investment account. Okay. So with the property dividend, you still have the same 3 dates. The only thing is, I guess the only thing extra here over a cash dividend is first, we're going to restate the asset that we're distributing to fair value and recognize a gain or a loss. Okay, so I'm just going to write that down here. So property dividends, first restate to fair value, or restate asset to fair value, and recognize a gain or loss. All right, and then after we restate the asset to fair value, then we can recognize the dividend. All right, so then we'll go through the 3 dates: the declaration date, record date, and the payment date. Okay, so to see how to do this, let's just look at an example here. So on March 14th, the board of directors of Echo Bay declares a property dividend. Each shareholder of record on April 1st, 2001 will receive 1 share of Attila stock for every 10 shares of Echo Bay stock. Echo Bay has 700,000 shares outstanding and 20,000 of treasury stock. Okay, so the dividend will be distributed on April 15th. Attila stock recently sold for 5 per share. Echo Bay sells for 20 per share. The Attila stock is carried by Echo Bay as an investment, and the book value of the distributed shares is $300,000. Okay. So we're going to distribute the Attila stock, and it tells us each shareholder of record will receive 1 share of Attila stock for every 10 shares of Echo Bay stock. So in this example, we have 700,000 shares outstanding. Again, dividends will never get paid on treasury stock because the company owns the treasury stock. So we have 700 shares outstanding, and we can divide this by the 10 shares of Echo Bay stock, since each shareholder record will receive 1 share for every 10 shares of Echo Bay. Okay. So that'll get us out to 70,000 shares of Attila stock to be distributed. Okie dokie. Now, as I mentioned before we can declare the dividend, we first need to restate the asset to fair value. All right, so right now we are told the Attila stock is carried by Echo Bay as an investment, and the book value of the distributed shares is 300,000. All right, so what is its fair value then, if we need to write it up to fair value? So if we look back through the problem, it does tell us Attila company stock recently sold for $5 per share. So in other words, it recently sold on the market for $5 per share. So that's its fair value. We can multiply that by the 70,000 shares that we're going to distribute. And that'll get us to 350. All right, so in other words, it's carried on the books at 300. The fair value is 350, so we need to write it up by $50,000. So to do that, again, it's carried on the books as an investment. So we'll increase the investment account by 50,000, and our credit here, we're recognizing the increase in the value. So we have a gain on the investment for 50,000. Okay, now after we've written it up to fair value, we can now start making our journal entries. So for the declaration date, we've pretty much just said we're going to issue, or we're going to pay out a property dividend of $350, right? Because that's the value of this property that we're getting. So we can debit property dividends. If you remember before, for cash, you just debited dividends. Technically, we should have debited cash dividends, but just to be clear here, we're debiting property dividends, and then our credit is property dividends payable. All right, so I'm just going to put out here what it was when it was cash, so you can kind of see these side by side. Right, so for cash dividends, we just did dividends and dividends payable. To be more clear, again, you could use cash dividends in front of it, but usually it's implied that if we just say dividends, it refers to cash dividends. Okay, so record date. Again, on this date, we just figure out who our stockholders are. So no entry under both of these for this. And then for the payment date, if you remember, for cash dividends, we just debited dividends payable, and we credited cash since we're paying cash. In this case, pretty similar thing. We've previously accrued the liability. Now we're going to pay it, so we can remove the liability from our books. And in this case, the asset we're going to pay, or we're paying with the asset of an investment. So we will credit investment for that total of 350,000 value, right? To remove it from our books. Okay. So this slide just goes over what we just went over. Let me just point out here that instead of debiting property dividends, it's also acceptable to directly debit retained earnings. Same thing for cash dividends. Other than that, everything here is pretty much just what we went over. All right, so moving on to the next topic is a liquidating dividend. So a liquidating dividend just means we're paying a cash dividend, but our retained earnings amount isn't large enough to cover the whole cash dividend. Right, so in other words, if you think about what retained earnings is, it's the profit of a firm that's been retained within the company. So in other words, if we don't have enough retained earnings to cover the dividends, well, we're really just returning the contributed capital of the company, right? So earlier we talked about, well, equity consists of two components: contributed capital and earned capital. Right, so earned capital is pretty much just retained earnings. So we're saying if we don't have any of this, well, now where's the equity coming from? It has to come from contributed capital. So in other words, we're just returning the investors' money to them. All right, since we're reducing contributed capital, we remember that we had two accounts under here, common stock and APIC common stock. Okay, so since we're going to reduce this amount, we're going to take it out of your APIC account. So to see how this works, let's just look at an example. Let's say McGill issues a dividend to its common shareholders of $1 million. Of this amount, $250,000 is a return of capital. Make the necessary journal entries. Okay, so declaration date, we're still declaring a dividend of $1 million. So your credit here will be to, dividends payable. We're not paying it yet. $1 million. Okay, so it tells us of this amount, 250 is a return of capital. In other words, what it's telling us is our retained earnings balance is only 750. So the other 250 of this 1 million must be a return of capital. So to journalize this, we'll debit our RE for the full balance left, and then the remaining amount of the dividend over the retained earnings balance is going to reduce your APIC account. Right, and then when it comes time for payment date, is again no entry on record date. Same journal entry as before. We're now paying off the payable we previously accrued, and then we're paying cash, so we'll credit cash for our money. Okay, and that's your liquidating dividend. The next dividend we'll cover is a stock dividend. So before we talk about stock dividends, just in general for dividends, dividends are distributed on a pro rata basis. Right? In other words, the dividends you share is proportional to the amount of the stock you own. So in other words, if you own 25% of the stock, you get 25% of the dividends. So with the stock dividend, it's called the stock dividend because the company is going to distribute its own stock. However, a stock's essentially a claim to the assets of a company. Right? You could distribute more stock, but the assets of the company aren't going to change. And so the value of the company itself isn't going to change just because you issue, if you issue more stock without getting cash. All right, so this is what's essentially happened with stock dividend. We're issuing more stock. We're not getting cash back for it. So the assets of a company aren't going to change, and the value of the company is not going to change. So just to see how this kind of works, we can look at the next slide. So let's just say a closely held company has 4 shareholders, each owning a quarter of the company. So they each own 25%. Each owns 100 shares. Total shares outstanding are 400. All right, so you can see everyone's getting the same slice of the pie here is exactly 1/4. Now the company declares a 10% stock dividend. Right? Again, dividends are on a pro rata basis. So if we're declaring a 10% stock dividend, that means we're issuing 40 more shares. So there's a 10% stock dividend, just means 10% more shares. So in other words, our shares outstanding right now is equal to 400. 400 times 10% is 40 more shares. All right. So since we have 40 more shares, well, and these are distributed on a pro rata basis, each person owns a quarter of the company, so each person gets 10 more shares. All right, so now if we look at their share of the pie after the stock dividend, each person now owns 110 shares. So they own a few more shares, but they still only own 25% of the company. So really, they're no better off after the dividend than they were before the dividend. Nothing has changed, and the shareholder really isn't getting anything at all. So if you're wondering why this happens, why would a company even pay a stock dividend? One possibility is just used as a publicity stunt. So in other words, a lot of people think if they get a stock dividend, they're actually getting something, but in actuality, they're getting nothing at all. So in other words, they're just getting fooled, and it makes them happy for no reason. The other possible reason, so there's a few possible reasons, but another possible reason is, as we'll see in a bit, when we account for a stock dividend, we're essentially going to reclassify retained earnings as paid-in capital. So if a company wants to reduce its retained earnings for whatever reason, it can do it through a stock dividend. So to account for stock dividends, the way we account for it will depend on the size of the dividend. Right, so accounting for dividends, or stock dividends, depends on size. Right, so pretty much we'll split them into two sizes, small and large. Small one just means the increase in shares is less than 25% of shares outstanding. And large is just the opposite, it's greater than 25% of shares outstanding. Okay, so we'll start by learning how to account for small stock dividends first, and then we'll go to large. So for a small stock dividend, as I mentioned earlier, the way we account for this, or kind of as I alluded to implicitly earlier, the way we account for this is we'll reclassify our retained earnings as our paid-in capital, or as paid-in capital. Right, so in other words, for the amount of the stock dividend, we're going to reduce our RE, and we'll increase our paid-in capital accounts. So paid-in capital includes both the capital stock account and the additional paid-in capital account. So capital stock and APIC accounts. Right, and so the amount we're going to increase these by will be simply for the, so for example, we will debit RE for the market value of the new shares issued. Right, and you'll record this market value in the common stock and APIC common stock account. And again, your common stock account will capture the par value, and this captures excess over par. All right, so see how this works. March 14th, 2001, the board of directors of Echo Bay declares and distributes a 15% stock dividend. Echo Bay has 700,000 shares outstanding, plus 20,000 shares held as treasury stock. Par value of the stock is $1 per share. Market value is $20 per share. Okay, so it's telling us a 15% stock dividend. So we'll take our 700,000 shares outstanding and we'll multiply it by that 15%. And if we do that, you should get to 105,000 shares. Okay, so we have the number of shares being distributed. In this case, it's a 15% stock dividend, so it's a small stock dividend. And as we said, to journalize this, we're going to take the value of this small stock dividend, we'll reduce RE by that amount, and we'll increase our paid-in capital accounts by that amount. All right, so we'll debit RE for the market value of these 105,000 shares. We're told the market value on the date that we declared this dividend is $20 per share. So we'll take the 105,000, we'll multiply by 20, and that should get you out to 2.1 million. So I'm just going to make a debit here to retained earnings for 2.1 million. Right, and then I'm going to record this 2.1 million amount into the common stock and APIC accounts. Okay, so again, common stock captures par. The par value here is $1, and in this case, we're dealing with 105,000 shares. So 105,000 times 1 is 105,000. And same thing as before, we now have the par value of the stock. The excess of the 2.1 million over par goes into your APIC amount. Oops. Okay, so that gets you to 1,995,000, right? And this is your 2.1 million minus the 105. Okay, so that's your journal entry. And then now you're wondering what would happen to the share price. Well, now the share price is going to decrease since we're just splitting the assets of the company over a greater number of shares. You don't actually need to know that part at the bottom of the slide. I'll just put that down there if you're curious. Okay, so we've learned how to account for a small stock dividend. Now we're going to learn how to account for a large stock dividend. In discussing large stock dividends, we're also going to simultaneously discuss stock splits because they're pretty similar. So both large stock dividends and stock splits will substantially or significantly increase the number of shares outstanding. So notice pay attention in these in that the company is not issuing more stock to raise capital. Again, with these, they're simply taking that same amount of the pie and they're cutting it into smaller pieces among the same set of owners. So again, if you're wondering why a company would do this, one reason is sometimes the market price of a stock gets very high. For example, it could be like over $1,000 per share, which would prevent investors from kind of readily purchasing it. So if we decrease the price per share, investors can more readily invest in our company. So for stock splits, a stock split just means we're going to split the stock into a smaller number of pieces. So I'm just going to erase this for a second. So with the stock split, let's just say we have a 2-for-1 split. Right, all this means is we'll split each stock into 2. Right, since we're splitting each stock into 2, this will also mean that the par value will be cut in half. So just as an example, let's say we have 10,000 shares of say 500 par value stock. And now we do for a 2-for-1 split. So afterwards, we're going to have 20,000 shares of $250 par value stock afterwards. All right, so a stock split just increases shares outstanding and it decreases par value. All right, so stock split increases shares outstanding and decreases par value. Right, for a stock split, if a stock split occurs, no journal entry is necessary because ultimately nothing's really happened with the company. Okay, so no entry for stock splits. Now for a large stock dividend, right, with a stock split, I just said it will increase shares outstanding and it decreases par value. With a large stock dividend, it will also increase your shares outstanding, right, but it does not affect par value. Right, or so maybe I should just say it does not decrease par value. Okay, so again, stock dividends, you could issue this as kind of like a publicity stunt, or for whatever reason. More importantly, to account for this, with the stock's dividend, we're still transferring retained earnings over to the capital stock account. However, since in this case, since par value is going to stay the same, we're just going to record the transaction at par value. So we'll just debit retained earnings and credit the capital stock and APIC, or actually, since we're just recording it at par value, we'll just debit RE and we'll record or credit our common stock for the par value. Right, so similar to a small stock dividend, we're still transferring RE. We're still transferring amounts from RE to our capital, our paid-in capital accounts. Right. However, we record this at par value, right, instead of market value, as in the case of a small stock dividend. All right, and so since we're recording it at par value, let me just point out here, right, since we're just going to reduce RE for the par value and common stock just captures par value, in this case, there's no need for an APIC account. Right, so there's no need for APIC accounts since it's recorded at par, and we use the common stock account to capture that par. So example, on March 14th, 2001, the board of directors of Echo Bay declares and distributes a 50% stock dividend. Echo Bay has 700,000 shares outstanding, plus 20,000 shares held as treasury stock. The par value of the stock's $1 per share. Market value on March 14th, 2001 is 20 per share. Okay, so in this case, we have a 50% stock dividend. We have 700,000 shares outstanding. All right, so the stock dividend will just be 700,000 shares times that 50%, which gets us to 350,000 shares. All right. Second part is what amount we need to record these 350 shares at. Since it's a large stock dividend, we're going to record it at par value. The par value of the stock is $1 per share. So we'll debit RE for 350,000. So that's just 350,000 shares times the $1 par value. Right, and then since we're going to transfer this over to our paid-in capital accounts, and common stock captures the whole par value, we can just credit common stock. So to just finish up here with this chapter, the next slide just shows you a stockholder's equity, a statement of stockholders' equity. So simply all this statement shows is it shows the beginning balance in each of our equity accounts, and then it shows how each account changes throughout the period. I'm not going to ask you much about this. I'm not going to ask you to prepare a statement of stockholders' equity, but it's kind of similar to retained earnings statement, except now you just have more equity components. And then the last few slides cover some financial ratios you can use to analyze equity. I'm not going to cover any of these. So again, that means I'm not going to ask you about any of this. So don't worry about the last few slides.